$26 billion. That's how much is sitting in tokenized real-world assets right now, quadrupled in 12 months. And while everyone was watching crypto prices, 600 US banks quietly agreed to settle loans using tokenized deposits on Ethereum. Not stablecoins, actual FDIC-insured bank deposits on a public blockchain. And in Japan, SBI Holdings just issued a $64 million bond that completely bypasses the country's national securities depository, with XRP rewards built in. Yeah, tokenization just stopped being a pilot program. Let's get into it. So here's a number that should be on every front page, but isn't. Tokenized real-world assets just crossed $26.4 billion in on-chain value. That's up from about $6.6 billion a year ago, nearly 4 times growth. And the composition tells you everything about where this is headed. 6 separate asset categories have individually crossed $1 billion. U.S. Treasuries at $5.8 billion, led by BlackRock's Biddle Fund at $1.9 billion alone. Private credit at $3.2 billion, up 180%. Commodities at $2.9 billion, mostly tokenized gold. Then corporate bonds, non-U.S. government debt, and institutional alt funds, all above $1 billion. Right, and the private credit piece is the one that really matters. Sidney Powell, the CEO of Maple Finance, said private credit is, quote, tailor-made for tokenization because it exists in, quote, markets where information is fragmented and assets are hard to move. Unlike stocks or treasuries that already trade efficiently, private credit is opaque, bilateral, illiquid. Tokenization doesn't just make it faster, it makes it possible to trade it all. And on March 5th, the Fed, OCC, and FDIC issued joint guidance saying tokenized securities with identical legal rights get equivalent capital treatment, technology neutral. That single statement removed the biggest barrier keeping banks on the sidelines. But let's reality check this. 26 billion against 28 trillion in US Treasuries alone? That's 0.02%. BCG projects 9.4 trillion by 2030. McKinsey says up to 4 trillion. Even the bears say multi-trillion is inevitable. The debate isn't whether tokenization wins, it's how fast. So tokenized assets are growing, but who's actually using them? This story answers that question, and it's not who you'd expect. Custodia Bank in Wyoming and Vantage Bank in Texas just partnered with Participate, a loan network connecting about 600 US banks, and they're deploying tokenized deposits as the settlement mechanism for commercial loan participations. Not stablecoins, not crypto tokens, actual FDIC-insured bank deposits running on Ethereum using an ERC20 token called AVIT. Now here's why this is structurally different from everything else in crypto. When a bank sells a piece of a commercial loan to another bank, the traditional process looks like a mortgage closing. Paper-intensive, multiple Fed wire transfers, and a timing gap between when the money moves and when the documentation executes. Custodia's system eliminates that gap entirely. The payment leg and the asset leg move simultaneously on-chain. Atomic settlement, one indivisible transaction. No more reconciliation delays. And Caitlin Long, Custodia's CEO, a 22-year Wall Street veteran who spent 6 years getting regulatory approval, she predicted tokenized dollars will replace the ACH network within 5 to 10 years. Quote, better, faster, cheaper, more transparent. A logistics company CEO is already using it to pay truck drivers within 1 hour of delivery. But here's what makes economists nervous. The Fed modeled what happens when deposits migrate. Each dollar of outflow triggers $1.26 in lending reduction. A moderate 500 billion shift could cut bank lending by 400 billion. Faster settlement means faster bank runs. That's the trade-off. Still, 600 banks signed up because the old way doesn't work. Live testing started late March. The FDIC chair himself said tokenized deposits should receive equivalent insurance treatment. The regulators aren't just allowing this, they're endorsing it. And now, from the US banking system to something that just happened in Japan that should change how you think about tokenized securities. SBI Holdings, one of Japan's largest financial conglomerates, just issued a 10 billion yen bond, about $64.5 million, that runs entirely on a consortium blockchain. And here's the thing, it completely bypasses JASDEC, Japan's National Securities Depository Center. Let me say that again. A major Japanese financial institution just issued a regulated bond that skips the entire centralized depository system. The issuance, the management, the redemption, all on-chain through Boostry's iBet for Fin platform, which is operated by 18 major Japanese financial institutions, including Nomura Securities. The bond itself carries an A- credit rating from R&I. That's investment grade. 3-year term, 1.85 to 2.45% annual coupon, and the minimum investment is just 10,000 yen, about $65. They deliberately targeted retail investors who've historically been shut out of fixed income markets. But here's where XRP enters the picture. For every 100,000 yen invested, bondholders receive 200 yen worth of XRP at issuance and at each coupon payment date through maturity in 2029. SBI owns approximately 9% of Ripple Labs. Their partnership goes back to 2016 with SBI Ripple Asia, which already operates XRP-powered remittance corridors across Japan, the Philippines, Vietnam, and Indonesia. Now, skeptics will say 200 yen in XRP is a gimmick. It's about $1.40. But that misses the structural point. This is the first major bond in a G7 nation to bypass a national depository entirely. The secondary trading launched March 25th on the Osaka Digital Exchange's START platform. Japan's security token market has hit 160 billion yen in cumulative issuances, a 5.8x increase year over year. Japan now accounts for 10 to 15% of global XRP trading volume, with 30 licensed exchanges. The infrastructure people said was, quote, years away, is processing real money right now. So look at what happened this week across 3 continents. 26 billion in tokenized assets, 4 times growth in a year. 600 US banks settling loans on Ethereum with FDIC-insured deposits. And Japan's SBI bypassing the National Depository with a fully on-chain bond, with XRP rewards. Every single one of these stories says the same thing. Tokenization is no longer a debate about if. It's not a pilot. It's not a proof of concept. The infrastructure is live. The regulators have cleared it, and institutions are using it. The question now isn't whether tokenization will reshape finance. It's whether you'll understand how before everyone else does. If this breakdown helped you see what's actually being built right now, smash that subscribe button. Drop a comment. Which story convinced you most? 26 billion in RWA, 600 banks going on chain, or Japan bypassing its own depository? I read every single one. See you in the next one.